Hi there, I'm Paul Bevan, Senior Advisor and Mortgage Broker at Dream Financial. Now today I just wanted to talk about one of the ways to increase your borrowing capacity when you're applying for a home loan. A lot of the lending criteria has tightened up in recent months, well probably the last 6 months. And it has affected many clients' borrowing capacity, known as serviceability. So that's the amount of funds that you are actually able to borrow. So one of the key things to do to increase your borrowing capacity is to pay out your credit cards before you're applying for any sort of home loan. Now that's probably something that you've heard before, but I just want to give you some detail around why that's actually a good idea. So when we're looking, or when a lender is looking at assessing your borrowing capacity or your serviceability, they'll have a look at your credit card limits, okay? So not the outstanding balance, but the actual limits. So you might have a $10,000 Visa, which you might pay every month, and bring it back down to a nil balance. You might have a couple of $100 balance on there, or like I said, a nil balance. The lender's still going to assess that as a $10,000 liability, that being your limit, because obviously the day after you take out your home loan, you can go and max that out to $10,000. So being risk averse, obviously the lender's going to say, no, we're going to include that $10,000 limit in your liabilities and your serviceability. Now, what does that actually mean? So that $10,000 as a liability, the lender will assess your monthly repayments on a 3% repayment amount, so that would be $300 obviously on a $10,000 card, and that's going to affect your serviceability anywhere up to around, your borrowing capacity anywhere up to around $50,000. So if your income and expenses indicate that you could borrow, say, $400,000, having that $10,000 credit card is going to reduce your borrowing capacity by around $50,000. So that's going to bring you down obviously to $350,000. If you get rid of that card, if you pay it out and close it down, you're going to be able to borrow up to $400,000. So you can see it does make a massive difference. So there you have it. I just wanted to explain one way that you can increase your borrowing capacity, and hopefully that's given you some insights into why you should be paying out your credit card and closing it down as opposed to just keeping it there with the $0 balance.